Dear students, we welcome you to our classes conducted by our YouTube channel, SL Account School. Today's topic is issue of shares. In this class, we are hoping to discuss issue of shares under various circumstances, and it is the same method for all different type of shares such as ordinary shares, preference shares, cumulative preference shares, etc. We will not be dealing with them separately. Of shares as fully paid, 4 steps. Usually a part of the money only will be called as application money. It will be debited to cash account, credited to application and allotment account. Step 2. On allotting the shares, debit application and allotment account, credit share capital account with the full price of this share. If any applications are rejected, step 3. The cash will be refunded, crediting cash account, debiting application and allotment account. Step 4. With the allotment, the shareholders are expected to pay the balance money, which will be cash credited and application and allotment account credited. Next, instead of calling the entirety of the subscription at the allotment, it can be deferred by first call, final call, etc., specifying different amount per shares. In a document called prospectus, the terms of issue will be detailed, maybe as such as application 2, allotment 3, first call 3, final call 2, dividing the $10 share. Please look at the second and third journal entry. When a call is made, debit the call account, credit the share capital account. When the call is received, debit cash account, credit the call account. Situation is issue of shares on pro rata basis. That is, when the shares are oversubscribed, the applications are more, all cannot be satisfied in full. Therefore, a percentage of the application will be allotted. This can be done on 2 different ways, either by totally rejecting the excess application on some basis or satisfying some as per certain percentage. When rejecting, debit application and allotment account, credit cash paid account. Issue made on pro rata basis will not affect the company but will have a bearing on the individual applicants. In case after the allotment, if still the monies of the applicants are remaining, they can be kept temporarily on a calls in advance account or may be refunded as prescribed in the prospectus. Next circumstance is issuing shares at premium. That is to say, paying at a higher price than the par value of the shares, which is known as share premium. Please look at the journal entries shown here. Except the second one, all others would be same. Here, the credit will not be only to a capital account, but also to a premium account with their respective amounts. The other situation is shares issued at a discount. This cannot be done unless it is permitted by a court of law. However, entries will be same except the second one, which is highlighted, where application allotment account debited and all share discount account is debited, but share capital account is credited with the full par value. Next, forfeiture of shares. When a shareholder defaults payment of allotment money or call money, the shares allotted to him could be forfeited. That is to say, the share issued will be cancelled without any refund to the applicant. The shares will be reverted to the company as their property. If they so wish, they can reissue them. When forfeited, the entry would be debit share capital account, credit forfeiture share account. The called up value per share. Then application and allotment account will be credited and the forfeited share account will be debited by the amount in default. Obviously, the call money or the allotment money. The credit balance remaining in the forfeiture account will be treated as gain on forfeiture and it's a capital reserve. Reissue of these shares will be as normal as other issues of shares. In case if there is any losses, that can be written off against gain on forfeiture account. The next circumstances is bonus issue of shares. Bonus shares are made to the shareholders free of charge when company thinks it is prudent to keep the liquidity within the company or restructuring of capital and reserves. The shareholders, on the other hand, when they are deprived of dividend payment, they can sell these extra shares on the open market and have their needs satisfied. Since bonus issues have no involvement of in or outflow of cash, there will be no changes in the ultimate net asset amounts. Bonus issues can be done in two different ways. Either it is paid as fully paid shares or they can write off the uncalled share capital. As a fully paid shares, debit bonus issue account, credit share capital account, debit various reserve accounts, credit bonus issue account. To the extent of the amount needed for the issue. If it is given as a settlement of uncalled capital, debit call account, credit share capital account, debit bonus issue account, credit the call account with the uncalled capital amounts, debit various reserve account, credit bonus issue accounts. The next one, redeemable preference shares. These are governed by statutory arrangements. Only these types of shares are allowed to be redeemed and no other shares can be refunded, reduced or repaid or restructured unless it is given permission by a court of law. In order to facilitate redemption of redeemable shares, the company will have to build up a reserve called Capital Redemption Reserve Fund. CRRF is built with distributable profits. The redemption will have to be built either by CRRF account or by issues made specifically for this purpose, and that issue again will have to be by a redeemable shares. Journal entries are debit redeemable preference shares, credit redemption account with the par value of shares, debit redemption account, credit cash account, debit reserve account, credit CRRF account. This account will be the strictest of capital reserves. The amount needed for redemption other than by new issue of shares. The next, a right issue, is a privilege given to the existing shareholders, and this is optional. The existing shareholders may use it themselves or renounce it in favor of another buyer of the shares. Issuing of shares will be same as other issue of shares. Scrip dividend is, instead of giving cash dividends, a certificate is given to the shareholders either for them to obtain the money on a future date or they can use this against the purchase of new shares from the company Here again the issue of share entries will be the same. Now let's look at some questions. T Limited has 500,000 ordinary shares. Directors have decided to issue a bonus issue, one new share for every 4 shares currently held. That is 1/4 of 500,000, which is 125,000. 4 options are given. Bonus issue will increase the share capital, therefore B and D are eliminated. Bonus issues are financed by reserves, therefore the answer is C. The next MCQ, N Limited currently has 12.5 million ordinary shares of 1 each. Market value is 2.5. Market value may be ignored as it is a condition outside the company. The directors decided to issue 3 new ordinary shares for every 5 currently held. 12.5 divided by 5 and multiplied by 3 will give an answer of 7.5. Par value of the share is 1. They are hoping to make a right issue of 1.5 per share. That is to say, there is a 50 cents premium for each share. Involved will be 3.75 million. 4 options are given. A. Increase of cash and share capital, ignoring the premium. Therefore, it is wrong. B. Debiting cash, crediting the entire amount to share capital, which again is wrong. C. Where the increase of cash is distributed to share capital account and share premium account, which is correct. Therefore, the answer is C. Okay, the next question is Shipping Limited issued 10,000 equity shares, that is ordinary shares of 25 each, payable 5 on application, 10 on allotment and 10 on first and final call. All the shares are subscribed and the amount duly received. Pass the journal entries. 1. When application monies are received, bank account debit, application account credit. When decided to issue, application account is debited, share capital account is credited at 5 each per share. Allotment per share is 10, therefore the amount is 100. Allotment account debit, share capital account credit. When allotment monies are received, bank account debit, allotment account credit, clearing the account. Next, when the first and final call is made, again 10 per share, therefore 100 debit to first and final call account, credit to share capital account. When it is paid, debit bank account, credit first and final call account. Final question. A company was registered with an authorized share capital of 2.5 million divided into 10,000 preference shares of 100 each and 15,000 equity share of 100 each. There are 2 types of shares. Decided to issue 4,000 preference shares and 8,500 ordinary shares or equity shares. Different payment arrangements are shown for each share. We are required to make the journal entry, cash entry and the balance sheet position. Issue of preference share, application 20 into 4,000, 80,000, debited to application account, credited to preference share capital account. 8,500 shares equity share at the rate of 20 is 170,000, debited to application account, credited to share capital account. When allotting preference shares at the rate of 30 per share, it is 120,000, debited to allotment account, credited to share capital account. Equity shares at the rate of 40, 340,000, debited to allotment account, credited to share account. Same way for the first and final call account too. Look at the cash book. 2 entries refer to application monies, 2 to allotment monies, 2 to the final call money. Now look at the balance sheet. The rest share capital is shown here. even though that is not a part of double entry. It is a legal requirement showing all four information, that is number of shares, name of the share, unit value and the total amount. Dear students, before we conclude, we recommend that you all do more and more exercises like this in order to get a better understanding of the subject. As you all know, these classes are provided to you by our YouTube channel, SL Account School. We kindly request you to subscribe, share, like, and promote it among those who are interested. Thank you very much.